Joining us now is Unlimited Fund CEO and CIO Bob Elliott and FS Investments Chief U.S. Economist Lara Rhame. Guys, happy Friday. Bob, with a jobs report this strong and the Fed already inclined not to cut in March, it doesn't seem like there's anything to throw them off of that game right now. The convention of wisdom, I guess, would be that it's bad for bonds. But is it really? Like, if you're holding for more than a couple weeks, a couple months, we sort of know where the direction overall is most likely to go.
Well, that's right. But the question is what's priced into the market. And we've moved from December, where we had almost 7 rate cuts over the course of 24 priced in. Now we're closer to 5, which is, movement in terms of pricing out the significant rate cuts that had been priced in. But remember, the Fed was at 3 in their dot plot in an environment where the unemployment rate goes to 4.1%. And the unemployment rate keeps surprising by staying right in that sort of 3.5 to 4 range. And we may not even get 3 cuts if unemployment doesn't rise as was expected by the Fed.
Okay, so Lara, how defensive on the equity side can you afford to be even in a market where Meta's up 20% after earnings and initiates a dividend?
You bring up the important point, right? Can we close this gap between what markets are expecting, so many rate cuts, and what the Fed has signaled without really getting a ding on the equities? As long as the data stay this strong, it looks like we can kind of have our cake and eat it too. That said, I think, beyond the 1, 2, 3 days, when you look out a year, valuations this high, you need to add something else into the equity portfolio besides just relying on those traditional equities.
All right. So how are you thinking about that? Maybe bonds are not the place to go, Bob. Maybe equity is looking more attractive right now. Where would you be putting money to work, especially in a day where we're talking about record highs for the major averages, but the Russell 2000 didn't have a great week. Regional banks back in focus again.
Right. And I think what that is you're starting to get the bears are trying to pick out the corners of the market that they think are going to underperform on a forward-looking basis. And the reality is that if we're going to have the strength of growth that we see right now, with the Fed, while maybe not cutting nearly as much as would be desired, still in that easier monetary policy stance, and a number of those areas like the regional banks, like the Russell 2K, the pricing, the valuation there looks pretty good. The idea that we might get a rotation into those areas of the market here in 24 looks pretty compelling given the overall growth dynamics that we're seeing.
Yeah, Lara, you do see the futures market, the Fed funds futures market, repricing based off of what we heard from Powell. Of course, everybody's going to be focused on that 60 Minutes interview that will be done with the Fed chair this weekend as well. But I guess what does that tell us about U.S. versus, say, international? Because we expect the U.S. to start cutting at some point this year. But other markets, it may take a little bit longer. So what does that mean in terms of that mix, especially when you are talking about equities more broadly?
I'm going to say something that probably will surprise a lot of viewers, but I think it's time to double down on the U.S. economy. The divergence, U.S. looking expensive valuation-wise versus the rest of the world, just because it's cheap doesn't mean you should jump in and buy it. I think there's a lot of room to harvest growth in the U.S. It may be a little more challenging to do that because public equities are expensive. So you're looking now at private equity, middle market lending. I could go on about other ways to harvest U.S. growth, but this is where we're seeing the productivity gains today. And I think that's going to continue for the rest of the year.
Bob, stocks or gold?
In this sort of environment, stocks are the way to go. You've got that strong growth, that momentum in the economy. The easing, the slight shift to easing is going to be more beneficial for stocks than it is going to be for gold, given it's not entirely, given that the pricing is the way that it is. You're probably going to get a little disappointment on the overall easing. And so that really, while stocks are, pushing new highs, this is one of those environments where the momentum in the macroeconomy is so strong, it can power through and really drive stocks higher. And frankly, meaningfully offset what you might see as losses in other assets across the portfolio.